Hi everyone. Good evening. Let me take this opportunity to introduce our guest for today. So today we have with us market veteran Sunil Subramaniam sir. Sir has got over 4 decades of rich experience and he has worked in various capacities in these 40 years, be it public sector, private sector, and the most renowned stint I would call when he worked in Sundaram Mutual Fund, and basically he retired as a MD of Sundaram Mutual Fund in the year 2024. He started way off in 2005 as a VP, and subsequently he took various roles. He was appointed CEO in the year 2015, and under his tenure, the Sundaram Mutual Fund, basically the AUM grew from some 2200 CR to 80 or 81,000 CR. So that was indeed a stint, I would say, and various recognitions as far as Sundaram Mutual Fund is concerned under his leadership. And even if we talk about personal capacity, so sir had been a member of SEBI's Mutual Fund Advisory Board from June 22 to June 2024. And even the Economic Times, he has been for 5 years in a row most promising business leaders of Asia. Likewise, in CNBC and Asia one of the greatest brands and leaders year 2020-21. And currently, he's on board of Studies Committee, basically catering to the finance area of the IFMR Graduate School of Business, Cree University. And in addition to that, he also serves as an advisor to various financial institutions. And by education, sir is an MBA from OOPS, London, and he also did his Masters of Science from IIT Madras, and his bachelor's were also from Loyola College in Madras. So, Sunil sir, very warm welcome once again. And just in case I missed anything on your profile or experience, I would kindly request you add to that, and perhaps would appreciate if you start how your journey started, and I mean being in various roles, and you how the transition happened when you came full time to mutual fund industry.
Sure, Prince. Thanks very much for that generous introduction. I don't think you've missed anything except that I retired about a little over a year ago as the MD, and since then I've been basically in the field of financial literacy. I've set up my own YouTube channel called Sense and Simplicity. I run a Facebook page called Marketonomics Simplified. So my purpose is to basically give back to society in terms of all that I've learned over my 4 decades of financial services experience. So I think otherwise you've not missed out on anything. And it's interesting that my journey actually, if you look at it, has been quite dramatic in terms of the changes that I've undergone. I actually started off wanting to be a scientist, and I was actually enrolled for the PhD program in the Indian Institute of Science in a very esoteric field called molecular biology. I was basically a biochemistry student. And then family circumstances meant that I couldn't pursue my doctoral fellowship, and hence I dropped out. And the only career then available to somebody without specific knowledge was banking, because you could write an exam and become a banker. So I wrote the exam. I became a provincial officer in State Bank, served there for 10 years. Then I shifted to a foreign bank, American Express, spent almost another 10 years there. And that's when I became head of corporate banking in American Express. But then again, the bank chose to wind down its corporate bank business worldwide, and I helped them do that, and then made the birth significant career shift where I think it's important to note that I am based in Chennai and I've lived in Chennai all my life. So job offers were coming to me in Mumbai, and I was not willing to do that because of my family circumstances. So the shift into asset management with Sundaram occurred for fairly family reasons, that an offer came to me to head the retail distribution of a mutual fund. I didn't know ABCD of mutual funds. This was way back in 2005. So I took the plunge headlong. Big risk because I didn't know anything about the asset management industry. But then I worked my way up there from sales, then moved on to deputy CEO, CEO, then international business. So finally retired as MD. So basically you can roughly summarize my career as first half it's in banking and second half is in asset management. So I think that's a good enough introduction. So I'm happy to take any questions that you have, Prince.
So it would be interesting to know the transition in the mutual fund industry since, I mean, almost 2 decades, I would say you started in 2005 and we are in 2025. So how had been the industry growing? And we see many veterans in the industry have started their own AMCs, mutual funds. So how you see this industry pan out going forward, sir?
So I see that it started off as a public sector industry. So initially there were all the public sector banks which had started mutual funds. Not all of them continued and thrived and survived. There were only one or two private sector players. One was Qatari Pioneer then. And all the rest of the private sector players like Allianz and Threadneedle and everybody finally got sold out and bought over. So what I've seen is it started with the public sector and then came the foreign AMCs for a bit, Fidelity, Morgan Stanley, everybody was into asset management sometime. Then they became disillusioned with it, and the Indian private sector took over in a big way, and they bought out all these companies. But then the next baton came over with State Bank making a big shift into asset management. And they, with their muscle of their branches, made it. And as you know, quickly they became the number one in the industry. Now the rest of the PSU pack is catching up slowly, but still, if you see the top, 10 players, I would say that the only one of significance is State Bank. Canara Robeco and Bank of India Mutual Fund are slowly coming up. So I think what's happened is that the industry has become domestic private sectorized because I think the foreign AMCs only Templeton is left over. A few other foreign partners are there as minority partners in SBI, for example. You have the French firm there. You have many other. You have a minority overseas partner. But overseas, you see, very few players are now left. So now it's dominated by the private sector, and more importantly, the bank-owned mutual funds are increasingly dominating the space because they control distribution. So I think what has happened is that from a manufacturing-led industry, it's now become a distribution-led industry. That's the biggest change. I see that. And the industry got a big leg up in COVID due to the whole digitization and the Jan Dhan Aadhaar mobile revolution, which got triggered during that period. So I think that has helped a lot. And the regulator has held a very tight control over the industry and all those things which could have led to malpractices like upfront commissions and all of that. Regulator has gradually tightened it and made the industry very clean from an investor protection perspective. So it's on very solid regulatory ground today. And now the regulator has become relaxing the thing. They have allowed new product launches like specialized investment funds. So I think the penetration of the industry has grown rapidly since COVID. I think from about 3 crore unique investors, now we are at about 5.5 crore. But in a 140 crore population, it is not even a glass half full story. It's a story that there's been rapid growth, but I think the journey ahead is going to be even more rapid in terms of its penetration, both in terms of new investors bringing them into the industry, as well as greater penetration of the existing wallet of those who are already investing in mutual funds. 60% plus of people's financial investments are in low return fixed deposits and post office savings schemes and the like, because people like that guaranteed return, though it doesn't beat inflation. So I think the industry it's at a promising juncture. You've seen suddenly a lot of interest in new AMCs coming up. It was at about 40 AMCs for quite a long time, but now over the last year, you've seen that a number of players have entered in. Now, these come from basically three types of sources. So one is a pure passive. So I think passives are caught up in a big way in India. And though they are only about 17% of the total assets under management, but it's rapidly growing. And there are easier regulatory guidelines for somebody to set up a passive only fund. For example, capital required is only 35 crores versus 50 crores for a normal. So a lot of players are entering purely. And Reliance Jio, for example, with BlackRock is one of those big players who's entering in the passives only space initially. The second aspect of the industry is those who want to penetrate into rural India, and SEBI has promoted the sachetization. So they have announced this 250 rupee SIPs and other products for penetration into the smaller towns. And there are some AMCs which have come specifically with that goal in mind, like a wealth company, for example. They have been very specific that they want to penetrate into the smaller towns. And the third type of new player entering in the industry, which is the real fascinating part, is that the portfolio management players are now increasingly applying for AMC licenses. And the reason for this is the launch of this new product called Specialized Investment Fund, which allows naked derivatives to be taken by a mutual fund. So it's basically eating into the space of the PMS and the AIFs with a much lower ticket size of only 10 lakhs compared to 50 lakhs for a PMS and 1 crore for an AIF. So I think that the PMS players are feeling a bit threatened, and they are now entering in, applying for a license so that they can, first of all, protect their own flock, because compared to PMS, there's a huge tax advantage to SIS. Coming under the mutual fund ambit, they are part of the easier tax of only 20% short-term capital gains and 12.5% long-term capital gains. Whereas in portfolio management, you have to pay the taxes, because each person churns his portfolio, he incurs a huge amount of short-term capital gains. So those people are now opening up primarily as a defensive gesture to keep their flock, but it's also a huge opportunity, because now, compared to a 50 lakh threshold, they can access customers with a 10 lakh threshold if they get an asset management license. So the industry is set for rapid growth from all these three directions, and I see that it's about 73 lakh crores now. I see that in just a matter of 2 to 3 years, we'll touch the 100 lakh crore mark. So I would say that the fastest growing industry in the country, one of the fastest, I shouldn't say fastest, in terms of the fact that there has got a solid regulatory foundation, a good past track record, as well as a huge underpenetration. The assets under the management, if you take the mutual fund AUM as a proportion of GDP, we are at 17%. The world average is 74%. So as you can see, there are miles to go before we sleep in this industry.
Rightly said. And recently we heard, sir, India Post is also deploying 2 lakh workforce for mutual fund distributors. So that is also visible sign of the industry size. So, sir, do you think, the PMSs, AIFs, and mutual funds, you're saying you explained it very well, but they both have great addressable market going forward, because wealth industry as a whole is expanding big time, and as you were initially saying, the financialization of economy is happening. People are getting aware of these products, and SIP has become a very common name. People are aware these days. How you see that, sir?
So what I see is that, like I said, it's at the margin that people, like say that a PMS customer, right, and he will look at a mutual fund investment that he's also made and say that on a post-tax basis, though they gave the same return, he's made a better post-tax return in mutual fund. And so there might be a temptation for them to switch to a SIF in a mutual fund which will get launched. So it's the fear of the threat. But otherwise, if you see, the PMS itself carries a huge advantage of customization, of executing specific thought processes, which even an SIF will not be able to do. So I think there is enough scope for PMS, AIF, and mutual funds, diversified mutual fund, to exist within the thing. Because when you are, getting into the super HNI segment, you don't want to get into a mass product which everybody can buy. So the PMS and the AIFs give a kind of exclusivity, which is very important, and they don't mind paying the price for it, but at least they get that exclusivity. So I think that attraction to the UHNI segment of a PMS AIF will remain. There's no threat. Just that, like I said, these guys also looking at an opportunity, because restricting themselves to a 50 lakh ticket size, now they can, through an SIF, the same set of fund managers can now do a 10 lakh ticket and take them and use them for their AUM gathering. So I think there is coexistence which will be there. There will be some churn undoubtedly, because they will cannibalize into each other to some extent. But I think the Indian market is large enough to accommodate all of these type of people. So I don't see a challenge. In fact, those are exciting times, because the customer choices are now going to be phenomenal. So a 10 lakh customer can look at SIF, can look at sectoral funds, he can look at plain vanilla diversified funds or hybrid funds. So based on two things, right? One is the risk profile of the customer. So what happens is that, see, earlier the ipso facto thought process was, oh, only if you can invest 50 lakhs, you have the risk profile to take high risk. But that's a very fallacy. Why? Because the risk profile comes from the nature of the individual and not amount of money he has. Somebody who has only 5 lakhs can be very risk taking, but he's got only 5 lakhs because that's the nature of his job or nature of where he was. But somebody who's got crores of money can be very conservative in their approach. So to earlier the association that, oh, if you have 50 lakhs, you can afford to lose the money, you can afford to take the risk was the thought process, which I think is can be challenged. The nature of a person's risk appetite is completely different from the wealth that he owns. Yes, the richer person can afford to take greater risk and lose it, but no rich person wants to lose his hard-earned money. He has earned it in some other business in the hard way. So he's also not keen to lose it. So where I'm coming from is that based on this new guidelines of 10 lakhs for SIF, even a person with lesser money but with a higher risk appetite can venture into this. And only when they do that will they learn. You see, one has to make mistakes to learn, right? One has to go and invest in SIF, learn what it is, then you can decide further to continue or not to. So I think a part of the financial literacy and education path is this step is also a part of that, I would say. And hence, to me, all of these things, they actually provide bells and whistles to the industry to actually attract a wider gamut of people into the industry.
Right, sir. So, sir, one aspect of the Indian market is it is promising investment place for everybody. Everybody is talking about India. Contrary to which the FII selling has aggravated in last couple of years. So, how you read that the DIS inflow has been increasing consistently, and so is the outflow of the FIIs. What is
So,
that which we are
so
missing here?
So what we are missing here is a very basic concept of price and value. Okay. So let me explain that in a layman's terms. Yeah, dal chawal is good for you, right? Dal contains protein. The chawal contains carbohydrate. Combined together, they've got all the minerals. So it's good for your health, right? Now you can go to a hotel and get the dal chawal for 50 rupees a plate. The same dal chawal costs 500 rupees a plate. What would you do? Would you pay that? You wouldn't, right? Let me take another example. A bottle of Bisleri water costs you 10 rupees in the city, and you happily pay that because this water is clean, not polluted, it's treated, comes from a well-known brand, well packaged in a plastic bottle, so you know it's not contaminated and all of that. The same thing costs you $1,000 in the Thar desert. There you have no choice but to buy it. So where I'm coming from is that there is a value for a product. So what is the value for dal chawal? The value for dal chawal comes from the cost of planting the seed for those pulses, watering them, growing them, harvesting them, taking them to the marketplace, selling them in the marketplace, and the profit margin of the farmer and the middleman who's taking it selling. All of this is a cost of production of that dal. Similar thing for chawal. Okay. Now, that cost of production plus what you consider a reasonable profit. Let's take it. That itself is disputable, but let's put a reasonable profit in there. That should be the price at which the market should be willing to pay for it, regardless of anything. Because his blood, sweat, and tears have gone into making that dal available to you. He has worked in the hot sun. He has, struggled. He's hired people to do the digging, to do the sowing, to do the harvesting. So all that mehnat, as they call it, has a price, and that's the price that it should sell, the cost of production in a right world, right? But if everybody in that area is planting dal in his farmland, the supply of dal becomes too much and the price crashes. So when the price was 10 rupees, now it goes to 2 rupees, people go and happily buy it. But that poor farmer, where lots of time he will commit suicide because his basic cost hasn't been recovered. So the key point is that the cost of production is what the market should pay. That is the value of the product. But the price that you pay for the product is a function of demand and supply. So similarly for a stock, right? Because we are now talking stock is nothing but a commodity. Only thing is instead of cost of production, what is the value of a stock? The value of the stock is the future earnings of that company. Because when you buy a stock, you become the owner of the company. Now, what is the rate at which you should discount the future earnings to today? Let's take there's a common equity risk premium or whatever, that's also commonly accepted. So people use what is called as a discounted cash flow technique to arrive at the present value of the future cash flows of this company that you're buying. That is a value. Now, will the market pay that price for that value or not is a function of demand and supply for stocks. Okay, when it goes beyond a particular price, you'll say no, especially if we have choices. So now we come to the fact that in the Indian market, a 6 to 6.5% GDP growth for the economy, a 4 to 5% inflation means roughly a 10% nominal GDP growth for the country has been discounted into the market. Now, companies which are in the stock market are at the top of the pyramid. They will naturally get a greater share of the profits, which this 10% nominal GDP represents to the country. But GDP is nothing but the national income of the country. Remember that. That's another definition. So now these companies will naturally grow at a higher rate of profitability than the nominal GDP. So let's give it another 2%. So let's say 12% is the rate at which the stock market earnings should grow compared to 10% nominal GDP, right? Now, for that 12%, with a common accepted riskiness of the country, the equity risk premium, you will say this country deserves. So, one terminology, if in stocks we use EPS and PE ratio to say the same thing, right? What is the price you're willing to pay for the earnings? That's the PE. When you say forward PE, is what is the price you're willing to pay for next year's earnings? Simple. But for the country as a whole, since we're talking about FIIs, there is something called as a market cap to GDP ratio. Because, like I said, GDP is the national income of the country, and market cap represents the combined prices of all the stocks in the stock market. So, the market cap to GDP ratio is what reflects the value of the country. So, now we come to FIIs and DIIs, right? Now, what has happened to India is that this growth rate of India is public knowledge. IMF say Laker, S&P say Laker. Everybody has given their own projections of India. They all vary. Or the Morgan Stanleys, the JP Morgans, they all put India somewhere between 6 to 6.5, let's say. And they have a certain growth pattern for the future. So that is discounted and that is there in the market price today. So now, what happens? So now you look at the two main people who are fighting it out the market to buy these stocks, the DI as a pack and the FIIs as a pack. So the DIIs, with barring very limited allocation to overseas securities which are permitted, which also RBI is curbing now, they have no choice but to buy stocks in the Indian marketplace. Because the SIP, because the distribution success, thanks to the AMP's campaign of mutual funds, I here using all the big celebrities to go and compare to people, the distribution muscle of the banks and the mutual fund distributors, MFDs and the RIAs were going and talking to customer, explaining, and the good past returns of our stock market by and large over a 3 year, 5 year period means that SIP book has been growing and flows have been coming into the fund managers and they've been going on buying stocks because they don't have an option. Because in hybrid funds, they can put a certain amount in debt. But in pure equity funds, apart from 10% or something in the cash portion, they have to then deploy everything into the stocks. So they keep buying. Now look at an FII, for example. For an FII, see for a DII, India is a country. For an FII, India is a stock. Because he has a choice to either invest in India or Brazil or China or the US or the Europe. So for him, it's a stock. So he has options. So the price at which India is selling is important for him from a price versus value perspective. Now, the story for India is that the future growth, the good economic growth story of India, thanks to our demographic dividend, we are the second youngest country in the world, all is in the public knowledge. So what is in the public knowledge is in the price. That's why in the Hindi parlance, there's a saying, Bhav Bhagwan hai, which means what is in the news is in the price. Now that means India's good story is in the price. So a foreigner has to buy India, he is buying a known story. Now, when you buy a known story, you make only the known return unless India surprises with growth on the upside. Which means that instead of 6 to 6.5 growth, if you're going to go to 7.5% growth, then it's worth for him to invest to get an outsized return. Whereas the Chinese market, we grow at 6.5. The Chinese market is growing at 4.5. But Chinese economy is $23 billion, 23 trillion. We are 4 trillion. So they are multiple times our size. And the Chinese P ratio is 11 compared to our 22. So that's for large caps. So for him, he is getting 4 to 4.5% growth of a much larger pie at 11 PE, and here you are at a 4 trillion economy who are giving you at 22 PE. So for him, he says, I have a better chance that the 11 PE can go to 14 PE when I'll make outsized returns by re-rating. Plus, I'll get the 4% plus the Chinese inflation, the nominal GDP growth rate of China. So it's always a constant situation of comparing India's price to the value and comparing that to the price value ratios of the other countries. And as and when that changes, you have all FIIs are not the same. There are FIIs like sovereign wealth funds which think about 10, 15, 20 years, who look at the growth over that period. For them, India still is good because they feel that in that future, India will get its act together and go to an 8 to 10% GDP growth. Then you have the mutual fund managers who do active calls, international mutual fund managers, 3 to 5 years. Then you have the passive international funds, right? Now, if you know the passive index is called the MSCI Emerging Market Index. India has 16.9% share of that index. China plus Hong Kong has a 30% share almost. So when passive money comes, we'll get for every 100 rupees, we get 17 rupees in that passive. Then the fourth category of the investor is the short-term hedge fund. Now, the hedge fund is a person who's a margin trader in Indian parlance. He takes 20% of the money he collects from HNIs all over the world, borrows 80% from a bank, and he bets on the market, which in a short 3 to 18 months time frame will outperform. So he leverages his trade. So his gamble or whatever you call it has to be very accurate. And when a foreigner is putting money into India, remember, over and above your stock market return, for him, one more very important thing is the way your currency is going to behave. Because he puts in money from dollars or pounds or yen or whatever, but when he takes his money out, if the rupee has depreciated, now they all put in a effective expected depreciation into their cost when they decide on India. But if India is going to depreciate more, he's going to lose money because of currency, whatever he makes on the stock market. So for them then, what is the key thing which determines India's currency movement? For India, that's oil price because 85% of our crude oil we import. So for a hedge fund, the most important thing is how is oil futures going to go? And if oil is shooting up, he'll pull money out of India and put it where? He'll put it into Brazil, which is a commodity exporter. He'll put it into Russia, which is a commodity exporter. But when oil is trending down, then India looks attractive. So why I'm saying this is, so now to answer your question on why FIs have been selling, it's because India all through this period has always been promising a 6.5% GDP growth rate and the earnings. But last year, around the election, for the first time, the GDP growth rate and the earnings disappointed. So a lot of FIs felt, I have bought India at a 6.5% GDP growth with a 4% inflation. We thought it's going to go to 7, 8, and I paid a premium for India. But suddenly that quarter last year, you saw GDP drop to 5.4%. So immediately that calculation had to be reset that India is a market not expected to go from 6.5 to 7.5, but has gone down to 5.5. And will it then come back to 6.5 is a call they need to take. They studied it. We found we came back. But the point is that the important point finally to say is that when the FII is sold, why does somebody sell? No, he sells because he expects the market price to correct so that he can re-enter when he feels that the price value equation is more reasonable. But in India, because the DIIs have been flush with money because of the retail investor pouring money into the mutual funds, they have never allowed the market to correct that significantly to make India a cheap country for an FII to invest. So in a way, the DII buying has prevented the FIIs from coming back very strongly. So that's where we are. And that's the reason even recently tariff issue has again brought what some analysts say 20 basis points, some say 30, some say 50, shaving it off our GDP growth, which means that the guys who bought India when he was at 6.5, expected to go to 7, are all disappointed because now it's 6.5 going to 6. So we have to wait. So the Independence Day GST rationalization was expected to give a boost. But we have to wait and see for the Council of Ministers. GOM has already approved it, but the Council has to approve it and implement it. And then the consumption number has to come and justify this 6.5% will be bounced back despite a tariff being there. So you can see there's a whole bunch of uncertainties around this growth path for India. And so FIS will only come back strongly to India when you see the earnings growth reflecting an upward trend from the current, whatever. This quarter's earnings is only at a high single digit for large caps and a low single digit for mid caps and small caps. So to summarize, right, I think India is fairly priced. So for if I already invested in India, he's tolerant, he'll be willing to wait. But future money coming in has to see a sharp uptick in earnings because India is never going to be a pure value market because DIIs will never allow it to correct. We can only be justified by not the PE ratio equivalent, but by the PEG ratio, which is price earnings, which is divided by growth. So the PEG ratio, as they call it, for India effectively, which is nothing but from an FIS perspective, overall, a market cap to GDP ratio, which is more reasonable, only then. And there's a projected GDP growth we have to use there, not the current GDP. So I hope I've given you a fairly detailed flow through. Is there any questions around this? I'm happy to answer.
Very helpful, sir. So the market has been waiting for the private Capex to kick in, but so far no visible signs. Any early signs or any triggers you see wherein we can see uptick in that, and going forward consumption also increases, and as you rightly pointed out, then they might get an opportunity if earnings comes in at those growth rates, so they will come in again. Yeah.
Yes, I see two signals of that happening. So the first signal I see is from the CEO of L&T, Mr. S.N. Subramaniam. He's given interviews in a couple of newspapers and online media, and he has said that L&T's order book is seeing a increased demand from private sector producers. L&T executes a lot of projects. So I think that his statement that he is seeing that all the big industrial houses apparently have placed some orders with L&T for some expansion plans. And so he has given a very positive indicator, and I would trust that because ultimately, L&T executes a reasonable proportion of the Capex project, which in turn they will outsource to the mid and small cap EPC contractors and the like. So I think that's a good signal coming in from the head of the largest infra company in India. That's one signal. The second signal is this whole GST reduction bit. See, as you know that because of the GST reduction announcement by the PM, people are tending to postpone their consumption today, wait for the GST cut before buying. So that's why I think he's also putting pressure on the council to quickly take a decision so that September they meet. He wants the decision to be announced in September so that this postponement doesn't last too long. But let's say it gets postponed till Diwali. Doesn't matter. The fact is, by Diwali, it will definitely happen because I see the confluence of three forces. So the GST reduction is the last one which has come through. But before that, the RBI rate cut, 100 basis points rate cut, right? Of which about 77 basis points has been passed on is what the governor mentioned. So the balance 23 basis points will need to be transported. So the EMIs coming down. That's the second push that is happening, and which the RBI governor has further strengthened because from 5th September, the CRR reduction also kicks in, which means the liquidity at the hands of the banks is going to sharply improve. Because remember, CRR is a drag because it's 0% at which the bank invests 3 to 4% of their demand and time liabilities with the government of India. 0% return. So even 1%, which is what ultimately going to get released, is a huge amount, which not only will help the profitability of the banks, because from 0%, whatever rate they lend, they'll make that on that 1% that is going to get released. But second is, from their own liquidity perspective, it's a huge boost. So the RBI governor has done more than his bit with the rate cut reduction, and with this, plus, they have pumped in enough liquidity through the OMOs and reverse repo auctions and all of that. So that's the second part. The third part, which happened almost first, I would say, is in the budget, the 1 lakh crores of tax benefit up to 12 lakh rupees, no tax. That's 1 lakh crores of cash in people's hands. Now, April, May, June, July, August are passing. People have taken that money and put it into saving. That's why the SIP book has been growing. If you see banks' reserves, their deposit growth is much faster than their lending growth. So what I'm going to say is all the three, the fiscal policy, the monetary policy, and the interest rate policy, all have come together. And now with the EMI is likely to come down, and all the manufacturers will also probably give up a bit of their profit margin to push the sales because they produce the cars, they produce the two-wheelers, but they're all lying at the dealers today and people are postponing. So there will be massive discounting, which I expect to happen around Diwali to get the product off the shelf into the customer's hands. So what I'm going to say is that this consumption will get delayed but not denied. So by Diwali and Christmas this season, I think the consumption numbers will show. And why am I focusing on that? Because the reason private sector has not stepped into capacity expansion in a big way is because for 3 years now, capacity utilization in the country is stuck at 76 to 77%. It's only with this Diwali season, hopefully that will take it closer to 80. And if you see the previous time India's Capex cycle took off was when the capacity utilization crossed 80, 2010-11. So I think that we have to hope, and I'm confident it will happen. There's a bit of delay, but let's say by December, January, the stock would have been sold off the shelves, and then the private corporate people will feel that for the next 2 years, they wouldn't have enough product to sell if the demand continues, and they will start because it takes about 2 to 3 years to build fresh capacity. So they have to start the process. But once that starts, the capex cycle will be in full stream. So I think this set of actions plus the L&T CEO's statement that he's receiving gives me confidence that we are not too far away from a private sector capex cycle kickstarting in, let's say, at least 6 months' time.
Perfect. So, sir, with the global developments happening across the globe, do you believe that brings some risk to the market? Because, as you rightly pointed out, uncertainty is something which market doesn't like, right? And even if we talk about tariff thing, that has not stabilized. Otherwise, it would have been discounted by now. So, what's your reading on the global order, or it's, I mean, not that material to say, I mean,
See,
in
I
your
will.
view, in
So
parlance
I
of
will say
Indian
one
market?
thing that uh, the US 50% tariff in the near term view, like it's not that important because less than 2% of our GDP is exposed to US exports is less than 2% of India's GDP. So in the immediate term, I think that we can counter. Yes, specific sectors will get affected, but overall GDP, like people said, worst case scenarios of 50 basis point cutting GDP. But definitely, if India has to grow, I would say that the US is too huge a market to ignore. Right now, tempers are running high. Mr. Trump's words have not helped. He has used very intemperate language against India. They have used India as a political pawn in getting Russia to the negotiating table. It doesn't feel good as a patriotic Indian to be treated like that. Your blood boils, right? But in the long run, because of the fact that the US per capita income is at $90,000 per capita, India is less than $3,000. So for our country's production capacity, we need an outside India market to which we can supply because our people cannot afford to buy what we can produce. As simple as that. Okay. Because of our population, over the next 20 years, sir, we are going to be adding 15 crore people into the workforce. China is going to lose 11 crore people. Indonesia is adding 1.5 crore people. So India has added huge amount of labor and we have to find a way to give them jobs. So I believe that right now, yes, we are saying we can manage that the US will find other markets like EU and all of that to substitute. Uh, Partly true, but over the medium term, this matter has got to get resolved. But I don't know how right now that's going to get resolved. So yes, for the future continued growth of India, and if we had to reach 8 to 10% GDP growth, the US as a market is very important. So maybe that day is 3 years from now when Mr. Trump is no longer president. Maybe that. But sometime in a post-Trump world, at least, India has to have a growing trade relationship with the US simply because they are 30% of the world GDP in economy. They are 70% of the markets is a different issue, but they are 30% of the world GDP. So I think that from a longer term perspective, this America issue has got to get resolved. Now, in a shorter term, happening is that Mr. Trump, through his actions, has actually brought BRICS together. So I think you've already seen that RBI has already given a circular that for opening Vostro accounts in rupees for foreign, banks and other authorized dealers, you don't need prior approval now. They can park their money in Indian G-Secs and earn return on that. They've already said to all the BRICS countries that we'd like to encourage rupee-based trade, and naturally we'll have to agree to real or rupee, ruble or that trade. So I think the BRICS as a bloc Mr. Trump has unwittingly made them very strong together. And to some extent, the immediate short-term pain will be handled by BRICS trying to support each other. I think the enemy's enemy is my friend concept has now got strengthened here. And I think we are now getting uh, less enigmatic with China. I wouldn't say getting really closer, but at least we are trying to separate the politics from the trade, right? So, and Russia, of course, has been our long-term friend. So, my point is that India and this focus on Atmanirbharta. See, point is like this. I come back to the point that at our high-end goods, right? Indians can't afford to buy the high-end goods we produce ourselves, right? So that's where the challenge of this Atmanirbhar Bharat has to be tackled on how much we are able to do this Make in India. These are good political statements, good thing, but at the ground level, skill level, productivity improvement, technology, AI, all of these are challenges which have got to be tackled by the country. And I would say that definitely there is going to be a period of uncertainty. Part of it will be solved by us, EU. Uh, but the problem with EU is that they've literally sold their soul to America. The deal they've agreed with America is very, very favorable to America. I mean, they have waived all tariff on American products and they agreed to 15% tariff on their products, which is, to us sounds like a very bad deal. So they are also kowtowing to America for whatever reasons because they are, I think, otherwise dependent because they are also high cost economies. But somewhere there will be a window for India to explore the EU as some alternative for the American products. There will be definitely BRICS as a substitute. And like I said, the drive to Swadeshi and Atmanirbhar will compensate. But all of that, I don't think will make up for the loss of future business which an America was there as a promise. See, before this whole junjet of tariffs and all took place, right? Even in the initial part of the Trump term, right? He said, Modi and I are great friends and we are great together. They agreed to build the total trade volume from 190 billion to 500 billion. Now that's gone with the wind. Where is that 500 billion going to come from if he's going to put 50% tariff on us? Because there are red lines here, right? He wants access to agri, to dairy, and to genetically modified goods. We can absolutely not allow that. So it's going to be a period of tough. The downside will be protected because of our domestic strength. The tariff downside will also be protected because RBI will allow a rupee to depreciate to a larger extent so that we compete against our competitors by using depreciation as a tool. And we will try to diversify a little bit into BRICS and to the other. These are all measures that we can take, but the total pain of it cannot be compensated, especially in terms of the future growth trajectory of India as an 8 to 10% GDP growth, right? That I think is not so clearly visible today. And that's the honest reality that we have to accept.
Right, sir. Although you touched upon a bit on it, sir, this China plus thing and all the narratives for different sectors we normally hear during the market chatter. But do you believe what has changed materially, be it the ease of doing business or maybe streamlining of economy, maybe these reforms, GST is one, and financialization of economy, be it the UPIs, etc. So anything additional you want to highlight which has changed on ground, or sir, we are more or less into narratives at this point
No,
in
I
time?
think at the ground level, I think uh, what's really changing for India, I would say, is the growth of startups and the entrepreneurial thing. Because Atmanirbhar, for example, in the defense side, right, this Indo-Pak war was fought on the strength of our domestic private sector defense coming up with drones and UAVs and all of that, right? So I think that the unleashing the entrepreneurial energy of our country. But people are very smart. Then you name the corporation in America, there's an Indian heading it or about to head it. Right? So Indians are the most talented country in the world. It's been our bureaucracy and our system, whatever it is, which has forced this brain drain for people to go outside and succeed. So I think that what this will trigger is, probably Indians coming back into India and putting their energies, their brains, their hard work to work in India. I think that's what the Prime Minister was hinting at when he did the independence speech and subsequent speeches. So I think that's something which I would like to see in a big way, that rich Indians outside India commit to coming and investing in India and using their skill set to help India grow. And I think that's something which will definitely this patriotism trigger will trigger, because you remember only when you're forced, we are like a cornered tiger, right? We have to be forced into a corner, then we get up and come fighting. 1991 was one such event which happened when we really transformed our country. And I think COVID was another challenge which we met. I think whenever we meet with challenges, I think India as a country comes back super strong. I think our strength comes through only when we are in danger. And I think Mr. Trump has presented us the golden opportunity, right, where he has put us under a feeling of threat, under a feeling of injustice, a feeling that we are being not done fairly by. And I think India will rise up as a nation and counter this. I think that confidence has come through because I'm seeing the way people are responding to this and going ahead. So I think that's one very, very positive change. That entrepreneurial thing, this one, the second. And the third thing is that I think the government will gradually, let go of the public sector's stranglehold on a lot of industries and get the private sector to flourish. They know that with the public sector, the way they are structured, with the guarantees of their salaries and the bureaucrats who are sitting on the boards and driving them, I think the private sector can do a much better job with the same set of assets and skill sets of land and labor that's available. So I think the government will realize that and use this as a good opportunity to privatize a little bit more of the private sector in key sectors, which can unleash these energies to do that. So that's a third thing which I see as a result of this whole Trump tariff tantrums, if I may call it that, is going to lead to in India. And finally, I think that we have to remember that all of this tariff janjat is around the manufacturing space, right? Whereas in the services space, India continues to grow its services exports very strongly. I don't think there is a significant competition. And I'm confident that our IT companies will come to terms with this AI revolution and will take the lead in AI-based consulting for companies across. So I think the services sector will also step up and give a strong support to the Indian, growth story now. So I think that's one. The final word, which I think is a new industry, which is really going to shoot up, is both in terms of power and energy and defense. So I think with nuclear power and solar power and all of that, I think India is already up on the curve. And this is where the collaboration with China, I think, will help. Because as you know, China is way ahead in terms of green energy with all their rare earth metals. So this trade partnership gives us access to the rare earths from China. And if we can do a trade collaboration together, because China also realizes that they are they are losing their working age population year by year. Their per capita income is $13,000 versus our three, so which means their labor is 3 to 4 times as costly. Their labor is much more productive than us, remember that. But China would also, in the partnership with India, probably try to push their low-end activities and manufacturing to India. I think that can be worked smartly in this whole process, that China does the high-end work and we do the low-end, and the product can then either be exported out of China or out of India, depending on the value chain cycle of that particular product. Some products need high-end finishing. That will get finished in China. Some need low-end finishing, like basically your mobile phones. Why is India getting a huge share? Because at the end of the day, the assembly part of it, our low-cost labor comes to aid that. So I think this partnership smartly structured with China as far as this kind of a shared, especially in areas like even pharmaceuticals, where China has a stranglehold on the API industry, right? So I think there are lots of areas where India and China can collaborate, where parts can be made somewhat there and somewhat here. And a good success story, which is already in the public domain, is Vietnam. Vietnam is today where it is because a lot of Chinese companies have used Vietnam as a place for low cost labor, and Vietnam has actually got the lion's share of the China plus one strategy compared to India, over the last few years. So I think that there are green shoots around these that should work. We have to work hard as a country, no doubt. But I think this challenge thrown to us by Mr. Trump is ultimately the factor that tomorrow, a decade later, we will thank Mr. Trump for forcing us to look inward, strengthen ourselves, and grow without the softness of having a 90,000 market to produce products and sell at a super profit.
Perfect, sir. A couple of more questions, sir. So basically, we are seeing a trend these days. Basically, the business houses, their new generations are more inclined towards setting up family offices and investing in market, be it maybe due to last 4 or 5 years of market returns have been very generous for all the participants. So is it a cyclical thing, or there is something structurally changing, or this is going to increase these, or in the past also, these kind of cycles happen when the markets are euphoric and these kind of things come out and later
No, I have a
they get
slightly
back to that.
different take on this. I think that it's because of the lack of opportunities to expand their capacity and grow their regular businesses that promoters are realizing that the market is discounting a very rosy future and the share prices are reflecting that. That's why promoter selling has spiked up sharply over the last couple of years, if you notice, because people feel that look, I don't my money to put it back into my company. I don't yet see the growth part because capacity utilization is stuck. Expanding more capacity, I don't know whether I'm going to be able to sell it. They haven't seen the growth part. So they are cashing it out and then they're putting family offices and they're trying to grow their wealth in the financial space, right? For the moment India's growth story picks up and private capex picks up, they will take that money. That's why if you see corporate cash balance, debt to GDP of corporate India is at all-time low. Whether you compare to our own historic past or you compare all the other countries, India's corporate debt to GDP is incredibly low because corporates are flush with cash, but they don't know what to do with it because they are not having the incentive to invest more into their business because they don't yet see that growth path coming because capacity utilization has stagnated. So this money, part of it is actually the corporates are themselves putting into liquid funds and mutual funds. So if you see the whole liquid mutual fund industry is flush with money from the corporates because the capex cycle hasn't picked up. So the first thing is when the capex cycle picks up is that liquid money will go out back into businesses. But even for that, companies, for example, if you take a company to invest in today, rather than expand its existing company, he will try to float a new company and expand it. Why? Because there is a tax differential of 8%. A normal company pays 25% corporate tax. A new manufacturing company gets paid only 17%, 15% plus 2% surcharge, 17%. So there's a huge tax at 10% of the margin and probably a 10% difference in tax if he sets it up through a new company. Now, when he sets up a new company, he will borrow money from a banker for the project, right? But the equity capital of that new venture has two choices, right? It can either come from the parent company putting its cash into that as a subsidiary, or it can come from the owner putting his money into it, which he has encashed in the stock market through his family office into this. So today they are putting their money into the financial capital markets because they don't see enough return from their existing and the capital markets is giving them a healthy double-digit return. So I feel that this trend, the moment private capital cycle starts picking up and all of this, you'll see some amount of people pulling money out of this kind of space, equity market space or the debt, retail, the real estate debt and all those AIFs with private credit and all of that. Some amount of that money will go back into the real India to the business. As a country, I would want that to happen. But as a industry, see, these people, these family offices, they are having very good quality fund managers who are taking smart decisions about what to do with their money. So they invest not just in direct equities, they put money into mutual funds, they put money into PMS, into AIFs, and they also put money outside India. So to that extent, right, they're smartly managing, as you know, I don't know whether you've seen this data, is that 60% of India's income is controlled by 10% of the population. But 80% of the wealth is with 10% of the population. And this wealth has been created through both private markets like PE and venture capitals and public markets, right? So this huge concentration of wealth in a few is one of the reasons that India's growth has also not picked up because there's a polarization of incomes. So this set of class of the top 10% or top 20%, whichever you want to call this top end of the population, naturally they have got a lion's share of the growth of the country in terms of the cash and they are having it and they're investing it. So I don't see that itself changing. So apart from a business owner who's choosing not to invest in his business and set up a family office, there are other people who just made money from the stock market and are reinvesting that money. That will continue as it is. So, but if India is to truly grow, we have to democratize this distribution of income and distribution of wealth. We can't have Just 10% of the country, taking away 60% of the national income.
All right, sir. And to close today's session, I ask the very basic question, sir, which most of the retail participants struggle with. So, what is the wealth creation mantra? What is something which majority of the retailers miss big time?
So I think if you see, from a retailer perspective, I think that the biggest thing that they miss is that the hot finger or button, whatever you call that, right? The desire to keep churning the portfolio, to keep acting on tips, to keep acting on thought process, keep acting on their own intelligence, right? Whereas the market is the biggest compounding machine of all time. It doesn't matter which asset class, which, large cap, mid cap, small cap, which sector, whatever. Diversification is key, obviously, but you allow that diversified set to go. Don't pull out of one part of that diversified set because it has underperformed. Because the simple mantra is what goes up must come down, what has gone down will go up. It's all a matter of time. So the key then is then how do you time these things? Do you just pick a flexi cap fund and put it and depend? No. Obviously, you have to think about what happens to your money. Because the one flexi cap fund is completely different from another flexi cap fund. So how do you decide? So then again, you diversify across cap curve. So flexi cap is one option, but you all know that 90% or 80% of flexi cap funds are large cap oriented, right? We have 65% plus in large caps. So if you need a good exposure, then multi-cap funds is a good option. Again, different people have different approaches to fund management. So diversifying across fund management styles is important. Right? Diversifying across asset class is important because as you all know, the whole fund management industry got the gold thing wrong. You ask anybody 5 years from before today, 10 years before today, they would all beaten on gold saying it's a, what do you call it, Thanda asset class. It has no earnings to support it. You should always buy equity. Gold have matched equity bank for bank. So the key is that you have to diversify because you don't know what set of forces around the world are going to make what thing go up. So that's where, say, diversifying is absolutely key across asset classes. That's number one. Second is that people, the one mantra for me, both the fact that you diversify, and second, I would say always rely on the expertise of a diversified set of fund managers. Okay. So do it yourself investing to me doesn't make sense because just take the Nifty when it started. You look at the Nifty 50 companies then, and you look at the Nifty 50 today, and you make a one diagram, you'll find that hardly 20% of the companies in the original Nifty are still in the Nifty. So just buying a stock and buy and hold on a stock doesn't work because that company may not exist. It may whole dynamics may change for that company and whatnot. So obviously, I would say rely on expertise, but diversify across expertise. But over and above this, the final thing is that do not make any investment decision whether it is debt, equity, hybrids, large caps, multi caps, this, that, whatever you time, every time you put fresh money, apart from already having put an SIP somewhere, you have to have a goal based on which you invest. And the reason for that goal is two parts, right? Because first of all, the lesson is that investment is nothing but a postponement of consumption. Nobody wants to build their wealth of 10 lakhs into 100 crores and die and in your chitta put all the notes and burn your body with it, right? There's a purpose to life. The purpose to life is to have a better future compared to today, which means that the money that you set aside to save or invest must enable you to buy a better future for yourself. Whether it's a better car, a bigger house, or a fantastic retirement or a great holidays in your retirement, whatever it is. The fact of the matter is that investment is nothing but postponed consumption. Now, unless you set a goal and say, this is the dream that I want to fulfill. This is the ambition that I have that I want my investment to deliver. And make that ambition crazy. You can buy a Hyundai Creta today. You set your goal, say, I want to buy a Lamborghini. Don't set your sights too small. Set it. But what I'm trying is, that's what will then make you stay the course because your money has to compound with the rate of inflation that a Lamborghini's today cost is compounding. Your money has to grow faster than that so that you're ultimately able to buy that Lamborghini. So that will help you stay the course. But more importantly than just staying the course, it'll help you know when to redeem. Now that investment is of no use if you just die with that money in a set of mutual funds or a set of stocks. You have to spend it while you are agile, active, and healthy to spend. So when you set those goals, not every goal is a retirement goal. Set a 5-year goal, set a 10-year goal for various things in your life. But when you achieve the money to achieve that goal, ruthlessly redeem your money. Don't look at then at the market. The market is booming. Everybody is saying your money is going to grow at 20%. So I let my money remain. So then that whole purpose of that investing is lost. You set the goal, you stay the course till your money grows to meet that goal. And at that time, redeem your investment and go and achieve that goal. Go buy that car, go on that cruise to the Alaska waters, do something with it. So I would say that the biggest mistake people make is they don't know. It's like that dog which runs behind a car. You would have seen in the streets of Delhi, Bombay, Chennai, wherever. When a car comes turning around, there's a god sitting in the curb. He chases the barking at the car till the car goes to the next turn. When the dog catches up with the car, he doesn't know what to do. It just swings away because it has no purpose to chasing that car. Most investing happens like that. You just greed is driving you. You say, "Oh, I want to make more return, more return." But that end goal, that what I want to do with the money when my money compounds and grows, people do not set that right at the beginning. You have to set that, but set it ambitiously so that you're all constantly stretching your investment exercise to deliver better results to achieve that goal. So simple to end that, friends, is to say that all investments should be linked to a goal. And when you're doing that, obviously rely on expertise and diversify across expertise are the two other things which go with that.
Thank you so much, sir. And I would say great note to close on that. Linking things to our goals is something which we majority of us miss. And you rightly said there is no point of that money until unless you link it to a goal and utilize that money for that goal. Very aptly said, sir. And it was a really interesting and insightful conversation, sir. Really glad you took out time for that and surely look forward to many more conversations going forward.
Thank you. Thank you, Prince. And thanks everybody for patiently listening and all the very best in your investment journey.
Thanks, thanks. And guys, you can certainly look out for Sunil sir's X handle and you'll find a link to his YouTube channel. So definitely more insights you can certainly get by connecting to his X handle as well as his YouTube channel. Thank you so
Thank
much,
you.
sir.
Thank you. Thanks so much.
Thanks, everyone. I hope you guys enjoyed this session. And one last call again, there is a defense webinar which we have planned and we have linked the link